Let's review the characteristics of S corporations first. Like C corporations, S corporations are recognized as a separate legal entity. In fact, in the eyes of the courts, there is little distinction between a C corporation and S corporation. Nearly the only distinction is the way they are taxed. The intent of an S corporation is to provide the same liability protection of a C corporation while avoiding corporate double taxation. This is done by passing income and expenses on to the shareholders, similar to a partnership. Thus, earnings are taxed only once. In exchange for this hybrid tax benefit, certain C corporation advantages are surrendered, such as shareholder-employee tax-free fringe benefits and the disallowance of the dividends received deduction. In addition, S corporations have troublesome eligibility tests, and reasonable compensation must be paid to shareholder employees. What are the S corporation requirements? To qualify, it must be a U.S. corporation. The shareholders must be citizens or residents of the United States. Only one class of stock is allowed, and that is common stock. The number of shareholders is also limited, and only individuals, estates, corporations, and certain trusts can be shareholders. Partnerships and S corporations cannot be shareholders in an S corporation. All shareholders must agree that an S corporation is what is wanted. At the outset, every corporation is a C corporation when first established. To become an S corporation, the shareholders must file an S corporation election using Form 2553. If the form is filed by the 15th day of the third month after the corporation is established, the election will be retroactive to the first day of the corporation's existence. When an attorney assists a company in creating the articles of incorporation, he should also discuss the S corporation election with the startup shareholders. If the organizers want the benefit of an S corporation, then the attorney will also file the election on behalf of the shareholders so that it won't be forgotten. Unfortunately, my experience is that most attorneys do not file the election for them. Consequently, I usually have to file the election under the late election provisions for my new S corporation clients. It's a good idea to find out what you can about how the corporation was filed before going through the effort of preparing a corporate return. On more than one occasion, I have had to do redo work because clients were unclear on their corporate status. In fact, recently, the sole shareholder of a first-year corporation approached me about doing his taxes. When I asked him about how the attorney set him up, he couldn't tell me, but assured me that he didn't remember any discussion about becoming an S corporation. He was certain that his business was a C corporation. I completed and submitted the 1120 to the IRS. A couple of months later, the shareholder received a letter stating that according to their records, this corporation was an S corporation and that the 1120 was being dismissed. It instructed him to resubmit the paperwork as an S corporation. Fortunately, he recalled telling me emphatically that he had never signed an S election, so he recognized his error and paid to have his tax return recalculated. An S corporation must be treated in every legal respect as a regular corporation, having shareholder and officers meetings, appointing officers and managers, etc. Failure to do so may result in forfeiting S corporation status. Having established that C and S corporations are very similar, let's review some of their differences. Some of these differences are complicated and lend themselves to abuse if the incorporators aren't careful or well informed. I'd like to share 4 common mistakes S corporation shareholders make. The first common abuse is unauthorized distributions. Payments to shareholders by a C corporation are called dividends, while similar payments in an S corporation are referred to as distributions. A distribution is declared by the board of directors and must be paid to the shareholders on a per-share basis. These distributions are considered non-taxable up to the shareholders' basis in the S corporation. The process of giving distributions is regularly abused in S corporations. More often than not, distributions are incorrectly treated as draws, as if the business were a proprietorship or partnership. The shareholders will take money out of the corporation without board of director approval. Our second common abuse is inequitable distributions among shareholders. An S corporation issues stock just like a C corporation, but it's limited to only one class of stock. So an S corporation can't give preferential rights to one class of shareholders and not another. It's not unusual for one shareholder to give a distribution to himself, but not to another shareholder. In other words, if shareholder A gets a distribution, shareholder B should also receive a distribution based on the number of shares he owns. Differences in stock voting rights among common shares do not cause the corporation to lose its S eligibility, but differences in distribution and liquidation rights can. The third most common abuse of S corporations is not paying a representative salary to employee shareholders and thus allowing more income to flow through to the shareholders as passive income. In a partnership, the profits are allocated to the partners between guaranteed payments for services rendered and net ordinary profit or loss, both of which are subject to self-employment tax, with some exceptions. An S corporation has the same system of allocating profits, but with one distinct difference. Shareholder employees do not have guaranteed payments. Rather, they are employees and issued a Form W-2. As with all other employees, FICA and income tax are withheld from their paychecks. The remaining net income is ordinary profit or loss, similar to a partnership, except that ordinary profit or loss is then passed through to the shareholders as passive income and therefore not subject to self-employment tax. This difference in self-employment tax is what attracts many taxpayers to an S corporation form of business. To better understand this concept, let's compare a partnership and an S corporation. If Mary was a 50% partner in a partnership and received $40,000 in guaranteed payments, as well as $30,000 for her 50% share of the partnership's net income, she would pay self-employment tax on the entire $70,000, which would amount to nearly $11,000. Now, compare this to what would happen with an S corporation. As an employee shareholder, Mary would receive paychecks during the year grossing $40,000. Two of the deductions on her paychecks would be for Social Security and Medicare, totaling just over $3,000 for the year. Of course, the corporation would match that and pay over $6,000 on Mary's behalf. However, the $30,000 in net income would not be subject to self-employment tax and would save Mary thousands of dollars in taxes. Granted, the closer Mary is to retirement, the more her contributions to Social Security and Medicare become important to her. So working towards an agreeable balance must be considered. If Mary wants to maximize her Social Security contributions, then she should either increase her salary or reconsider her choice of entities in favor of a partnership. By not paying a representative salary to employee shareholders, it allows more income to flow through to the shareholders as passive income. For instance, I've seen and heard of numerous occasions where the shareholder employees are paid no salaries, even though they may work in the business. This abuse is easy for the IRS to catch, and when discovered, comes with serious penalties to the abuser. When you discover that this is happening, you should consult with the company officers and warn them to correct the abuse as soon as possible. And finally, S corporations often deduct more loss than allowed. An advantage of an S corporation is its ability to directly pass corporation losses through to the shareholders. One misconception is that an S corporation can pass through deductible losses without limitation. In truth, shareholders have to overcome three barriers before deducting loss on their individual tax return. These barriers are basis, investment at risk, and passive activity losses. The workbook explains each in detail. Only losses that make it through all these applicable limitations are eligible to be deducted on the shareholder's tax return.